Welcome to Bloomberg Markets. I'm Yousef in Dubai. Coming up, European stocks climb, buoyed by China's latest stimulus measures and wagers that U.S. rates are approaching their peak. Friday's U.S. jobs report supporting a potential Fed pause, with the data showing a labor market undergoing a controlled cooling. And oil holding steady after hitting the highest level since November on expectations that OPEC Plus supply cuts will tighten the market. It is Labor Day in the United States and Canada. The regular band is out for a holiday, and I've taken over for the interim period. I want to get straight to some of the market action for you, get you a little bit of visibility of what is open. What we do know is currently offline are the cash U.S. equities, and there's also no cash U.S. treasuries. But we do have a bit of an indication with the S&P 500 mini firming up by about 0.1% on some of these latest China stimulus measures. The folks at JP Morgan out with a new note, also Goldman Sachs making an argument around the story out of China. But in terms of valuations, those are looking stretched for JP Morgan. International equities much more attractive. We have the 2-year German Bunds, especially given what we saw with the country selling 5.5 billion euros of 2-year government bonds. That's coming up at the beginning of this month. Eurodollar is at 107.97, so a weaker greenback, and then Brent crude just hovering short of $99 a barrel. I want to get to this chart and set the scene with what is happening with assets in China. It is all about real estate. China builder shares surging with the nation boosting property support, shares advancing as much as 8.7%. We've taken the BI China real estate index here, and it comes after the country cut down payments for home buyers and encouraged lenders to lower rates on existing mortgages. So what that means is that first-time home buyers can renegotiate their mortgage interest rates with banks. Goldman Sachs says they expect the recent measures to help restore home buyer sentiment. I want to get out to Geoffrey to help us digest some of the latest news flow. He's the BNY Mellon senior market strategist. As much as you've got a good chunk of U.S. markets that are offline, Jeff, there's plenty to get through around the China angle. How do you interpret the latest measures? And is it really going to make a meaningful dent at a time of anxiety about structural reform in the country over there?
Morning. So I think what was more significant than even the housing measures, if we look at things holistically, is actually finally the government in Beijing, they're targeting the household. They're trying to help household cash flow. So along with the housing and the mortgage announcements last week, there were also announcements regarding taxation, so greater tax deductibility on issues like childcare, on elderly care. I think that on a comprehensive basis, coupled with the improvement in household cash flow from mortgages, really is a sign that they recognize, at least in the short to medium term, the household really needs to drive growth from very, very low levels.
So what does positioning look like around this narrative? Given your analysis, what do you recommend clients do in terms of actionable trading and guidance?
Well, we still like emerging markets full stop. Looking at our custodial iFlow data, we think clients are still very underweight emerging market assets in general. We actually do like emerging market bonds at this point, especially on a hedged basis, given FX has done quite a bit. If you look at Latin America, for example, these are very good, a very liquid bond market. They could be able to capture a bit of the commodity lift from stronger Chinese growth, and we find that clients are very underpositioned in this space as well. So this is one sector which we are really closely looking at.
I want to take across to the United States. We're reflecting on economic data from last week. I'm also looking at notes from folks at BlackRock who are saying that 2-year treasuries, which are very sensitive to what the Fed does, those are, quote, a screaming buy. The trade is in steepeners, is what Societe Generale argues. We have a chart on the terminal. This is the 210 spread. Whether or not the steepening is going to finally begin is an entirely different question. But do you subscribe to the broader economic view at play here?
Well, we subscribe to the view that the Fed is still going to be higher for longer. Let's be clear here. There's a big difference between labour market growth softening versus a labour market weakening, right? These are two very different things. Right now, what we're seeing is wage growth starting to stabilise, to slow a bit with the JOLTS report. Openings are starting to slow as well. That is very different to saying, oh, the unemployment rate is shooting up, wage growth is contracting and things like that. So if you look at it in an inflation context, I think the Fed can shift the narrative towards holding rates where they are on a sustained basis. But if you're looking for rate cuts or anything like that, I think that is way too early to even discuss.
I mean, I kind of wonder what kind of lenses I need in the morning now, given everything that's happened last week, because there was a time where, bad news is good news and good news is bad news. Which broader paradigm are we in today in the U.S.?
Yeah. I think good news is good news, really. So you are seeing a slowing economy. You are seeing, that path towards a soft landing, I would say, being achieved. Everyone is going to welcome that. And on top of it, in a broader risk allocation basis, with the negative narrative, so to speak, in China starting to stabilize as well. I think that is a conducive environment for risk. But you mentioned U.S. equity valuations earlier. That has, at least in recent weeks and months, been outperforming. The European narrative, on the other hand, is much softer, and that's where, if let's just say for the sake of it, you are looking for negative news, we probably focus a bit more on at this point.
Okay, so if the Fed's pretty much done here and we're getting to peak rates, does that mean we're getting to peak greenback as well? Because I was looking through a note from Standard Chartered, and they're saying, you know what, we're getting close to a scenario where it makes a lot of sense to add dollar shorts on a tactical basis in particular.
Well, the only area where we would probably add dollar shorts is probably against dollar Asia. So if we look at some currencies like the Thai baht, like Korean won, if the China narrative improves, that's where the dollar could struggle a bit. I'd be very, very careful, on the sell dollar against euro or sterling narrative right there, because if the Fed's going to be higher for longer, I don't think the same can be said for the likes of the ECB or BOE, where growth headwinds, we're looking at the potential for economic contraction is much more pertinent. So you could see the Fed staying where it is, but the ECB and BOE talking about easing at an earlier horizon. I know the BOE narrative is still for hikes in the short term, but that's where the divergence is going to come to play. So for dollar bears out there, I think patience is needed. That's not where I would prefer to play dollar shorts at this point.
Okay, point taken. In terms of some of the Fed speakers this week, I mean, we don't have any major economic data, but we have plenty of verbiage to cut through, including from the New York Fed President John Williams. We've got the Boston Fed President Susan Collins. She's going to be speaking at the New England Council in New York. How are they going to manage the message here, Geoff, if what they've done over the last 4 to 8 weeks could be considered successful?
I still think it's going to be a case of data dependency, and now they can so justifiably point to the data. We're pointing to the data and saying that the U.S. economy, at least the labor market and inflation risk, is heading to where they want to see. Now, again, no pre-commitments, no central bank is going to pre-commit at this point. If you look at the ECB commentary, really not committing to anything, even though inflation numbers actually surprised to the upside in September. So we need more data prints and perhaps to confirm a trend, but from the Fed's point of view, in terms of their communication, reinforce the previous message. But again, the higher for longer narrative, I think that's going to be the anchoring assumption, and I think that's going to determine how the yield curve is going to behave up ahead.
Also speaking this week is going to be Christine Lagarde from the ECB, and in many ways the European inflation story is a lot trickier than what the US has to deal with today. How do they bring this home and make sure that inflation and these cost pressures stay under control within mainland Europe?
Well, you hit the nail on the head there. In her centrist speech, she was very clear about the divergence in various parts of the economy in terms of labour growth. You've got low productivity sectors like construction, like services in the Eurozone actually driving labour market growth, whereas manufacturing is in the opposite direction. So from her point of view, it's balanced. Where does she see the balance of risks up ahead? Is the decline in the manufacturing sector so steep based on the PMIs up ahead that it's just going to drag down the economy, drag down overall demand as a whole? Or are those other sectors still driving higher inflation impulse in the Eurozone? So she actually has a much narrower path to cross compared to her colleagues in the US. So let's see how that developments are going there. But she needs to expand on what she mentioned during her central speech.
Geoff, I'd love to leverage some of your strategic insights, which are built from years and years in the front lines of the industry. And I look at European stocks, and I begin to think, whether those valuations stack up. Because one thing's for sure, this is something that JP Morgan drives home, is that the MSCI US index on a forward price to earnings ratio is high, considered the rising level of real bond yields. PE multiples show a positive correlation with EPS momentum, and an earnings revision might turn lower. Again, if anybody's looking at Europe, willing to add Europe, where do they add in Europe?
Well, on a tactical level, so in the manufacturing sector, that's where we again, looking at our flow indices, I'm seeing a bit of a pickup, on a relative basis. It could benefit from improved Chinese demand, especially on the infrastructure side. If you see investment demand picking up, that correlation clearly is there. But having said that, as always, be wary of the notion of value in Europe. Looking at the banking sector right now, so the lending surveys are pointing to decline in demand, declining supply. And let's be aware, what is the ECB trying to achieve here? The ECB is trying to tighten conditions still. So can you actually point to a good valuations environment for European equities and just for European growth as a whole? I'm not sure we are there yet. We really need to see the PMIs stabilise in the Eurozone before making a compelling case. And also, let's be clear, Euro is soft, but in a weak export environment, that's not exactly going to compensate for a decline in export volumes. And heading into the winter, if energy prices go up again, just watch for margins as well. So I don't think the case is compelling for Europe yet. Going back earlier, I prefer to, let's just say, go into the safest risk asset. EM bonds is what I like right now.
I mean, you read my mind, Jeff, because that was going to be my follow-up question. Brent crude up 4.8% over the last 5 trading sessions. We're, back close to the highs we haven't seen in about a year. In terms of Brent at 88.49 a barrel, that brings back memories of global central banks panicking, trying to bring down cost pressures. Is a second wave, material wave of cost pressures priced incorrectly, or would you say that's being disregarded at this point?
I would say it's somewhere in between. I don't think it's being disregarded. Central banks are wholly cognizant of the risks right now, and we can see, what supply changes can do. But at the same time, we don't have that reopening demand impulse, that we saw last year, where everyone was scrambling for supply. If anything, yes, we might get a bit of a China growth bounce, but it's really not going to move the needle, especially for given China's a largely coal-driven at this point. So I think it's an inflation risk to be aware of. They will need to incorporate it into their forward guidance up ahead. But net-net, it's not going to be the same situation as last year. The dynamics, the demand dynamics in particular, are completely different.
Jeff, this has been a lot of fun. Much appreciated. Great to catch up. That's Jeff Yu of BNY Mellon.
Absolutely.
Let's get you a bit of a snapshot of what else is still to come. Chinese President Xi Jinping skips this week's G20 meeting in India. We'll have more on his controversial decision next. This is Bloomberg. Welcome back to Bloomberg Markets. I'm Yousef in Dubai. Now to another trending story. Chinese President Xi Jinping won't be attending this week's G20 summit in India. It's the first one he's skipping since taking power in 2012. Joining us now with a look at what is behind Xi's decision is Bloomberg News Director for EMEA. That's Rosalind Matheson. Roz, there's a lot of mystery around why the Chinese leader decided to snub the G20. What are you hearing from sources?
Well, that's the key question. Why did he make this decision? Is it driven purely by the desire to snub his Indian counterpart, Narendra Modi, who's hosting the summit? Of course, we've seen an uptick in tensions between China and India of late around their long-running border disputes. Is it really that he needs to stay home and focused in China on the turbulence that his economy is facing? Is that the priority behind it? Or is he really just trying to shift again his focus towards alternate power blocks? He recently attended the BRICS summit in South Africa, and he's looking to build out those as an alternate potentially to what he sees as the Western-driven agenda. Is it a combination of all three? We may never know. The question is, what is the repercussion of these actions, of course, on this summit, including the China-India relationship, but also for China and for Xi Jinping on the global stage?
I mean, let's flesh that out in a bit more detail in terms of a fraught China-India relationship and to what extent that was a factor in the decision-making in the upper echelons of the Chinese government around the G20. What can you tell us in terms of that dynamic?
Well, of course, these tensions have been long running between China and India. It's interesting, though, of course, when Modi and Xi both came to power, they had quite a good relationship. There's famous pictures of them sitting on a swing together talking about normalising ties, improving ties between their countries. But it's really been on a downward trajectory since then, certainly over the past 5 or 6 years. In particular, there's border disputes, there's tensions over technology. India has been slowly drawing further into the orbit of countries like the US in some of those alternate power groupings, and certainly critical of China in its behaviour over trade and investment. And so you've really seen that kind of like overhang that relationship. And perhaps Xi Jinping is saying, well, I can use this as a moment to signify my displeasure with Modi by sending essentially my deputy to a meeting that he has attended normally every year since he came to power. What that means, of course, is that the very top levels of power in China and India are not communicating. I mean, there's no desire to let these border disputes spiral out of control, but in the longer term, there's no desire to improve ties either.
The message is carefully managed within China about anything related to the top levels of the government in China. How is this story being spun locally?
Well, certainly the message is that the Premier is perfectly capable of going to a meeting like this and representing China. Of course, Xi will point out that he recently did attend the BRICS summit in South Africa, and he's very attuned to matters at home. I think for ordinary Chinese, the message will be it's business as usual, very focused on the economy. And of course, all eyes will be on whether Xi Jinping does travel to the US in November for the APEC summit, because that, of course, is where there's been a lot of talk that he might finally have a proper sit down again with the US President, Joe Biden. That really is the most important relationship when it comes to China. So they'll probably focus on that kind of conversation. What's the dialogue with the US? We've seen a parade of US officials coming to China in recent months to try and reset ties there. So the focus within China is very much it's business as usual. It's no big deal if he doesn't go to this meeting, and the focus really is on the US-China relationship.
This has been fantastic. Really appreciate it. That's Bloomberg's Rosalind Matheson. We still have, of course, an important breaking line hitting the Bloomberg as ARM kicks off its IPO roadshow this week. We're going to be looking at what is a busy September in terms of public offerings. But the red headline hitting the terminal right now is about Alibaba, about the cloud fundraise that we've all been looking forward to. And that may draw state-backed telcos. The understanding is we're talking here about 10 to 20 billion yuan of a round before the Hong Kong listing. So that translates into about 1.4 billion US dollars to 2.8 billion dollars at the upper end of the range. That's according to people familiar with the matter. Plan to spin off the unit is by distributing a stock dividend to shareholders within 12 months. That's what the company had announced back in May. We'll continue to monitor. Much more ahead. This is Bloomberg. Welcome back to Bloomberg Markets. I'm Yousef in Dubai. September shaping up to be a busy month for IPOs for ARM to Instacart. Alex Webb of Bloomberg Quick Take joins us now for more. So run us through then some of the superlatives and why it's worth counting down to these.
Well, look, there's been, as we've been reporting a lot recently, a massive slowdown in the IPO market over the past 2 years, partly, of course, to do with those higher interest rates. And so there's a real anticipation that if this ARM IPO does badly, then it will make it a lot harder, or there'll be a lot more caution from other companies waiting to pull the trigger on going public. We've heard about firms like Birkenstock and Instacart also eyeing IPOs. Now, of course, if the ARM IPO goes well, that isn't any guarantee that the others would do well. It is in a different space. Chip makers pretty hot right now. If ARM is able to convince investors that it is an AI-led stock similar to NVIDIA, AMD, and others, then it gets a juicy valuation. It's unclear that they'll be able to do that.
Okay, Alex, what about the latest lines we got on the terminal within the last 10 minutes about Alibaba's cloud fundraise that could draw state-backed telcos? The nuance of the state-backed telcos you deem significant. Why is that?
Yeah, I find that particularly interesting because at the moment, the relationship between the cloud operators and telecoms firms around the world is sort of one of frenemies, that the telecoms operators often sell cloud services from Google Cloud or Azure or Microsoft Azure or someone else. But at the same time, the cloud operators are getting closer and closer and closer to the edge of the network, i.e. they're putting servers very close on telecoms towers. Some see that as a threat to the telecoms operators. So it looks as though if the telecoms operators in China invest in Alibaba Cloud, as it is being reported by our colleagues in Asia, then it could make them a tighter relationship and less of a threat.
Alex has been super helpful. Good to see you. That's Alex Webb of Bloomberg Quick Take. We didn't get to talk about the iPhone launch that's also in the pipeline the next couple of days. We'll do that another time. Let's get you a snapshot of what is coming up in the next few minutes. Friday's U.S. jobs report. We'll do a preview and a review because that supports a potential Fed pause, with the data showing a labor market undergoing a controlled cooling. U.S. equity futures called marginally higher on U.S. Labor Day. Much more ahead. This is Bloomberg. Welcome back to Bloomberg Markets. I'm Yousef in Dubai. Let's check back in with the markets because, yes, it is Labor Day in the U.S. and Canada, so quite a bit of the regular volume is offline, but we still have some indicators to work with. The rest of the world, for the most part, is online. So on the S&P 500, many were called higher by 1/5 of 1%. There's not going to be any cash stocks or treasuries trading on the U.S. 2-year, or rather the German 2-year. This one I pulled up because Germany announced they're going to sell 5.5 billion euros of 2-year government bonds at a time when there's already a debate about a glut in terms of supply. Currently, we are up by 0.9 of 1%. Your euro dollar is pretty much bang on 108, up 1/5 of 1%. And then Brent crude is short of $89 a barrel. I want to get now to an important conversation around the Fed speak that's on tap following Friday's U.S. payrolls report. The data gives a mixed picture of the labor market as job creation exceeded expectations, but the unemployment rate inched higher. Joining us now for more, Sandra Horsfield, economist at Investec. Sandra, I mean, you talk about the latest data being something that the market could finally put its teeth in, but I also get the sense that there is a hint of stagflationary signs from this latest batch. Do you agree?
Certainly, I think we have to look at the big picture. The big picture, what the Fed has been trying to achieve is to achieve disinflation without too much pain. And the latest data that we've had have been quite supportive and helpful. Certainly, I guess if you'd asked the Fed a couple of months ago before the summer, would you be happy with these sorts of numbers? I guess the answer would have been yes. We are seeing softer job growth. We're seeing some rise in unemployment, but not a really big downturn in the offing. We're getting similar messages from the surveys, which are softening and pointing to a cooling economy, but no collapse. And that's a fine balancing act to strike. Obviously, the quicker you get down in terms of inflation, the more pain it entails. So you do need to balance both sides of the picture. The Fed must be relatively pleased with how it's going so far.
Well, that's according to your report card, so they get a thumbs up. But in terms of what that means for the terminal rate, our clients can get the perspective, GTV Go. This is a look at the Fed's terminal rate at 5.5996 at the moment, with an upper bound of 5.5. So what is going to come from this point onwards? Because there's now only a roughly 50% chance of a 25 basis point rate hike that is priced in. Where's the thinking at Investec on this?
Our thinking is where the market is not too far off. We may now be at a point when we are at peak rates. It is obviously not certain because much does depend on data. We have a data-dependent Fed. They're stressing that time and again. So far, the data don't give strong reasons to go even further. Obviously, you don't need to go further if you are getting enough of a disinflationary pictures. And we didn't just have the payrolls figures, but we actually had some inflation numbers on the Fed's own objectives phrased in PCE inflation, as well as on the CPI reports, which do suggest that momentum on the inflation side is helping. So probably we're thereabouts in terms of interest rates, we think.
You also think that the ECB hit peak rates with its July interest rate increase. To what extent is there a risk of a surprise additional leveling up of interest rate hikes, that a reacceleration will be warranted, given what we're seeing in commodity prices, especially energy?
It's a very important question. What we've seen recently in Europe is the pictures of the oil price moves starting to be translated into petrol price rises. And yes, we may still be getting some downward moves in terms of consumer headline prices because of natural gas being much lower than it was. But natural gas prices have crept up again. So how much disinflation will you still get from that force? Perhaps not that much going forward. There's a bit more to come because of lags in the system, but certainly the energy price side doesn't look quite as helpful going forward as it has as a driver downwards of inflation. So the question is, where do you get disinflation from? And I think a lot there relies on the goods market. We have seen manufacturing starting to perform weakly and very weakly for some time now in the Eurozone. We'll need to see this reflected on the price side as well. So hence, we think that will be the main source of disinflation that will allow the ECB to pause at this point.
Sandra, a lot of it has to do with demand, resilient demand, potentially resilient demand over the next 6 to 12 months. And that ties us back to China because we're seeing quite some euphoria in property stocks. The Chinese government announced a series of measures to try and offset some of the weakness. We saw property stocks pop in the last few hours. A Bloomberg intelligence gauge of developer shares was up 7.2%. That is the most in about 7 weeks. Are you convinced by the steps that the Chinese government is taking? And is that going to settle the matter for the markets? Because at the moment, you know, we do get these spikes, but they often don't last.
I think it's very hard to declare call the bottom really on China's property market. The issues are quite entrenched. We're dealing with an economy that is generally quite soft. We are having issues whereby youth unemployment in China, we do know is very high. So if you think of the people who could be first-time buyers in the Chinese market, well, they're not looking at a rosy picture right now. So there are issues there. And certainly the property developers are feeling it. It's a large part of what has driven Chinese growth in the past, and it is still difficult for the government to get to grips with. It has repercussions for the wider economy, for government funding and for bank funding as well. So we think a difficult period still does lie ahead, and I don't think we can quite say we're out of the woods despite the latest, more positive steps.
Sandra, we're going to dive deeper into some of these themes. Sandra Horsfield of Investec stays with us. Let's get you a bit of a preview of what else we have in the pipeline. A 10% correction in equities could be on the horizon. We're going to hear from Nouriel Roubini of Roubini Macro Associates. That and plenty more. This is Bloomberg. Welcome back to Bloomberg Markets. I'm Yousef in Dubai. International leaders, economists, and CEOs gathered over the weekend at the annual ABRDN Forum in Chernobyl, in Italy. Bloomberg's Francine Lacroix sat down with Nouriel Roubini, the chairman and CEO of Roubini Macro Associates, and asked if he sees a chance of a global recession.
Compared to 6 months ago, where there was a serious risk of a real hard landing for the global economy, those risks are reduced right now.
No.
That's the good news, but I think that there's still an open discussion on whether the global economy is going to achieve a soft landing as opposed to a bumpy landing, where a bumpy landing will be a short and shallow recession. That short and shallow recession has already started in the Eurozone. The UK, with very high inflation, is probably headed towards that recession as well. In China, there is a sharp slowdown of growth. It's not just cyclical, it's more structural. United States, still the jury's out on whether we'll achieve a soft landing or whether there's going to be a short and shallow recession. So it's a mixed bag.
But that depends on what? So in the U.S., is it Fed policy, or is it just a tight labor market that could suddenly collapse?
Well, in the U.S., paradoxically, so far, in spite of Fed hiking rates above 5%, the economy has grown recently above potential, tight labor market, tight goods market. That's good news in terms of achieving a soft landing, but it's actually bad news for the Fed because it implies that the Fed is not done yet. They may have to hike once more, maybe twice more. Eventually, the Fed funds rate might have a 6 handle rather than a 5 one. And the more that happens, the more the risk that eventually there might be at least a short and shallow recession. But the economic data recently have been reasonably strong, even if it's slowing.
What do you make of China right now, and what are markets most misunderstanding about the world economy and actually how equities and bonds should behave?
Well, China, the reduction in growth is not cyclical, it's structural. It has to do with aging of population, debt and leverage, housing overhang, state capitalism, a backlash against the private sector that depresses the sentiment of household and the corporate, geopolitical depression, the policies that are effectively Marxist-Leninist of Xi Jinping and so on. So I think that potential growth used to be 10, went to 5. I think it's at best 3 to 4%, and that's not going to change because it's emphasizing security control over opening up and reform. That's the main thing. Yep. I would say on markets, in my view, if the global economy is going to weaken, if there is still a meaningful chance of at least a bumpy landing, probably markets have rallied too much today. And that's maybe going to lead to a correction in the second half of the year. If the economic data are still weak and if central banks have to hike a little bit more as a way of essentially fighting inflation, and that's going to lead to a nominal and real rates rising as well. And that means that probably bond yields may go higher rather than lower while inflation is still high and central banks are still fighting inflation.
But a correction, what, a 10% correction in equity markets, or is that too high?
Well, a 10% correction is not totally unlikely. If the economy starts to soften up globally, and if you have still inflation that is above essentially target, with core being still high in US, UK, Europe, central banks hiking somehow more, I would not be surprised if in the second half of the year they get a 10% correction in global equity markets.
So what would you do if you were Bank of England governor?
Well, Bank of England is facing a dilemma. On one side, growth is lower, and is lower also because of a self-inflicted goal that was the Brexit decision by the UK to reduce potential growth and increase cost of production. So it's the most likely case of stagflation. On one side, the economy is headed towards a sharp slowdown, potential recession. On the other side, core inflation is still too high, and therefore you face a dilemma, or a trilemma in the case of the Bank of England, because you want to have lower inflation, but that's going to cause a recession, and higher interest rates are going to imply eventually financial instability, because private and public debts are high, and debt servicing ratio are going to rise as interest rates go higher. So you might have actually a perfect storm in the case of the UK.
Is there anything that actually fiscal policy or just government policy can do to try and mitigate that?
Well, fiscal policies are also in a dilemma, because if you want to maintain growth, you should have expansionary fiscal policy, but now fiscal policy cross purposes with monetary policy. If you have too much essential inflation, it's because there was too much demand. That implies that cyclically, structurally, fiscal policy should be retrenching. The opposite is happening, and that's make the goal of central banks of achieving price stability harder rather than easier.
Let's get out again to Sandra Horsfield, Investec economist, to flesh out some of the points that Nouriel Roubini was making. Of course, the author of Crisis Economics, one of his many theoretical works in the world of economics. Sandra, the concept of a hard landing and whether the IMF is a little bit over-optimistic with its GDP forecast for 2023 of 3%, which is higher than the prior figure, 2.8%. What's your take?
I think at this point, we would say that things are looking more difficult. Yes, we have had a good start to the year in many ways. It has surprised people, and it gives mathematical base effects, which make the full year figure better than it might have been otherwise. And so there have been upward revisions over the course of this year to take into account the news we've already had. If we look forward, though, we do have to bear in mind more of the pain from high interest rates is yet to come. We are likely to feel this increasingly, not just in terms of housing, but also in terms of investment for companies as well as construction sector in particular. So that is likely to slow the economy further. We're not yet at a point where just because interest rates may be at a peak, the pain associated with it is. So softer growth is probably likely, and indeed recessions may well be in store in the UK and the US in particular. Quite possibly the Eurozone may be heading for a soft patch too.
Sandra, I want to build on that just in terms of where the UK is. We had comments out from Jeremy Hunt, the Chancellor, and he made the point that it is going to be inflation divided by 2 by year end, so that they're going to reach their target. He reaffirmed that 5% by December 31, 2023. Is that a realistic projection?
We would think it is. We're quite hopeful this will be met. One of the factors is simply the structure of how electricity prices are set and gas prices are set at the retail level in the UK. And their filtering through is likely to reduce the inflation rate quite a bit further by the time we come to October. That's going to be a very helpful factor still in driving headline inflation rates down. On top of that, we already talked about the weakness in the manufacturing sector. We think that side of things, where we're likely to see further competition in goods prices, also will help to lower inflation pressures. Less good news
Sandra,
on the services side.
If I can jump in and just get a call for year-end for the cable trade. I know you're not an FX strategist day to day, but still, what are you using to plug into your economic models here?
I think at the moment it's very difficult to step away from the prospect of interest rate differentials as a key driver of FX rates. So right now, if we think that in the US and in the UK we're probably at a peak rates and the market is not too far off, probably very big moves are unlikely at the current rate. Fundamentally, we still think sterling is probably undervalued, and as we head into next year, we may see some further gains. In particular, we're likely to see the dollar weaken, but that's probably not an immediate near-term story as yet.
This has been wonderful, Sandra. Thank you for making it to the show in a very busy morning schedule. That's Sandra Horsfield of Investec. Let's get you a bit of a view on what else is around the corner. Volkswagen CEO Oliver Blume tells us how his company is trying to rev up sales of its electric models. We're going to get into that in a moment. This is Bloomberg. Welcome back to Bloomberg Markets. I'm Yousef in Dubai. Volkswagen is adding improved design to a string of changes aimed at enticing more buyers as sales of its EVs lag in China. Bloomberg's Oliver Crook spoke to the Volkswagen CEO at the IAA car show in Munich.
The auto show in Munich, the IAA, is a great opportunity, first of all, for the German automotive industry to show the progress in terms of technology. But we have guests, visitors from all over the world, and for us it's a good opportunity to share experiences, how we will develop the mobility of the future. In terms of Volkswagen Group, we have the opportunity to show the progress in Volkswagen Group. I'm in charge since 1 year, and yesterday the Group Media Night, we presented the progress of our 10-point plan, how we are, what priorities we are taking in terms of products, finance, regions like China and North America, software, technology, our platforms, mobility services, and sustainability. And so for us, it's a huge opportunity also to show a glimpse what products our customers can expect in the future. Very promising, and I'm looking very much forward to it.
Right, and a year is a long time in the auto industry, particularly right now. A year from now, what will you be hoping, where do you expect Volkswagen to be, and what would you want to be speaking about at the Munich Auto Show then?
Yeah, we are updating our existing platforms in terms of electromobility. For example, the MEB in Volkswagen called MEB Plus. Yesterday we have shown a glimpse with an iconic GTE brand, what customers can expect in the middle of this decade. Next year we will come with the new platform PPE for Audi and for Porsche. In the background we are showing the Audi Q6, and driving this car, testing this car, it's so promising and exciting. what we bring there. And then developing fast our future unique platform, SSP, with a lot of stunning projects. And so I think there you can expect a lot from Volkswagen Group during the next years.
And what is the consumer changing? What are they demanding from you now, and how are you meeting that demand?
We are in the middle of the transformation, and it is about electrification, digitalization, connectivity, autonomous driving. And I think Volkswagen Group is well prepared. On the one hand side, we have traditional strengths in terms of driving abilities of our cars, the high quality level we do have. Then yesterday we announced that we move Volkswagen Group to a design-driven company. We are very strong in design, and that will be an important differentiating factor for the future. And combining this with new technologies, developing our platforms and combining this with partnered solutions in the different regions of the world, being able to offer the ecosystems our customers are expecting in the different regions of the world.
That was the CEO of the Volkswagen Group, Oliver Blume, who started his career all the way back in 1994 at Audi. I want to get out to Bloomberg's Craig Trudell, who joins us now from London to talk more broadly about cars. Craig, I was in Chamonix over the summer, the French resort town. I took out an electric Toyota, drove around with it, and didn't really get a lot of kilometers under my belt because I had a range problem. Now Mercedes, with their new CLA model, are looking to set the standard with 750 kilometers of range.
That's right, and in a very small package, right? The CLA is you know, sort of a Model 3 fighter, I think, is the best way to think about it. I do think that you know, this is a model that's going to be hugely significant for Mercedes when we think about the transition that this company is making and where they've gone electric first. They've gone electric at the higher ends, and so we've seen you know, impressive specifications and models, attractive product coming out of Mercedes, but not necessarily the volumes, and you wouldn't expect that at the higher end of the range. The CLA is where they do an awful lot of volume, and so for them to get this product right is going to be massively important for the success of this transition that they're trying to make from combustion to electrification.
I mean, they're also grabbing headlines with this baby G-Wagon that's meant to be electric, which is very counterintuitive to what you see when you see a G-Wagon, which are these monster V8s and V12s back in the heyday. Craig, what else is on your radar?
I think the electric baby G-Wagon is absolutely you know, sort of a head-turning idea that was very smart on Mercedes' part to throw out there. I think BMW with Neue Klasse, the sort of changes that they're making, you know, to really prepare for the next few years of dedicated electric vehicle platforms. BMW has taken this approach for some time of, you know, sort of diversification and not necessarily shown, you know, full commitment to going all EV, offering models that, you know, can sell with all sorts of different powertrains. I think that represents, you know, their big effort to go fully electric.
Craig, I always love a car chat. Thank you for that. That's Bloomberg's Craig Trudell. Here's what's coming up. Skylar Montgomery Koning, Global Data TS Lombard, Director of Macro Strategy. Discuss with her. This is Bloomberg. Welcome to Bloomberg Markets. Let's get you a bit of a snapshot then of what we're looking at in terms of the top stories. European stocks climb, buoyed by China's latest stimulus measures and wagers that U.S. rates are approaching their peak. Car makers from around the world descend on Munich for the IAA car show with a focus on EVs. A Nobel Prize-winning economist Joseph Stiglitz tells us why he's worried about China and Europe, but thinks the U.S. is going to be okay. Welcome to the program. It is Labor Day in the United States and Canada. Happy Labor Day if you're celebrating, but there's plenty of other action in most parts of the world. And on the S&P 500 Mini, which is one of the few indicators we can work with out of the United States, we're currently called higher by 1/5 of 1%. U.S. stock valuations are looking stretched. JP Morgan is preferring international equities. They describe them as much more attractive. Looking here at the German 2-year, we are off by 0.03. Look out for the announcement from the German government to sell 5.5 billion euros of 2-year government bonds at a time when there's already a debate around the potential glut. Euro-dollar just short of 108. The greenback weaker on that China stimulus move. And then Brent crude holding firm just short of $89 a barrel. I want to get to the wider markets, get an additional view here. Bloomberg's Sam Unstead has been looking at some other important indexes. Sam?
Good morning, Yousef. Yeah, I think interesting today that we're seeing quite a good picture for European stocks. European stocks are actually hitting some solid highs today. I think you got a little follow over from the US on Friday. The jobs report pretty much came in exactly where expected and probably just about exactly where markets wanted it to. So kind of controlled cooling of the economy over there. And then China this morning as well is giving the markets a boost. Mostly sentiment, I think, but I think you're also starting to see some of these tinkering around the edges from Chinese authorities are starting to feed through a little bit, which I think you saw particularly with the home sales in some major cities.
Sam, thank you for the roundup. That's Sam Unstead. Let's widen out the debate and bring in Skylar Montgomery Koning, Director of Macro Strategy at Global Data TS Lombard. Skylar, describe to us then how significant the measures are from China, because we saw assets in mainland China rally significantly, especially in some of the property plays. What do you make of it, and what are you telling clients?
Yeah, I mean, I think for China, what we saw was a very initial strong rebound at the end of 2022. So the Chinese recovery story from there was very strong, but since then it just continues to disappoint, right? And part of the problem is that households are very cautious. They're unwilling to borrow either to consume or to invest. On top of that, the nature of the stimulus has changed. So the threshold for stimulus is higher, but also stimulus is slower, and it's not flooding the market like the historic experience. That said, as we've discussed, broad weakness, it is forcing more stimulus. We are getting more, and that means overall, we think that activity will continue to decelerate through the second half of this year. But employment and stimulus will stabilize growth in late 2023. So that's very much an L-shaped recovery. So while it can get better, it's certainly not good in China.
I'm wondering to what extent the currency is a major consideration in this equation, because the signal that's coming out from the onshore-offshore convergence on the local currency, sending a positive message because they're trading with almost identical rates as of Monday. What do you make of it?
Yeah, I mean, I think for us right now, actually, dollar CNY is one of our favored longs. I think, it really comes down to the basics of growth and rate differentials. They are sharply against the yuan. In China, yes, the stimulus continues to disappoint, and the economic recovery is underperforming expectations, I'd say. And we think this is set to continue. So markets will continue to be disappointed by the scale and the efficacy of that stimulus. At the same time, the broad balance of payments that's turned against the yuan, the trade surplus is deteriorating as exports slow, outbound tourism is picking up, and there's a strong drive by corporates and households to diversify away from China. And yes, there is concern in Beijing about the speed of depreciation in the yuan, which is why you have seen intervention in the past week or so. But it's more stopping the rapid decrease rather than stopping depreciation altogether. So we're still comfortable being long dollar CNY.
I mean, for the pros out there, most of the time, the offshore yuan is priced with a slight discount. Skylar, what else does the Chinese government need to do here to keep momentum on their side? Because you're getting a little bit of it in the last couple of trading sessions.
I mean, I think the problem is that we're still going off of the model of previous Chinese recoveries in terms of the market is looking for this flood of stimulus that will have a positive impact on global growth. It'll have a positive impact on commodity prices because it's infrastructure based. And that's just not the recovery we're getting. And so I think it's very hard to see a sustained uptrend when you aren't getting that kind of recovery. And so you get these little bouts where the market's turning more positive and it thinks that you're going to find the bottom. And, given the amount of sentiment that's negative within China and Chinese assets more broadly, we are likely bottoming in terms of other assets and equities and risk more broadly. But it's very hard to see a rebound in the actual currency without that kind of stimulus, and we're just not getting it. And I think on top of that, you have such a large differential in rates between the US and China that it's very hard to be long.
Let's dig deeper into U.S. Treasury yields. You just mentioned some of the bond yields. I'm looking at 2-year yields and compare that to a note from Jeff Rosenberg of BlackRock, I mean, he's getting really excited about this. He says they were screaming buy. Can't remember the last time he wrote that. Do you subscribe to that?
Yeah, I mean, I think we're moving through a backdrop where we had this perfect storm for U.S. fixed income that was very bearish. So we had the BOJ yield curve tweak, we had a U.S. debt downgrade, there was increased U.S. issuance, and obviously that's continuing. But we've also had, a major point of why you've been able to have risk assets rally at the same time that you've had higher yields is that there's been resilient growth. But, the fact that we've had this kind of perfect storm of bearish points to some overexuberance in the move, right? So no doubt, U.S. issuance increasing and being sustainably higher, that continues to put upward pressure on yields. But the medium-term outlook is very dependent on the economic and Fed outlook. For us, we expect a recession and deep Fed cuts. But even without the recession, the Fed can cut quite significantly. And fixed income's reaction functions to cuts is very clear. There's a rally across the curve with the biggest move at the front end and steepening. And for us, that means we also like being long the 2-year point, where especially at the front end, there's this yield upside risk is limited because the Fed's at the end of the tightening cycle.
Yeah, and that chart was just showing the 2-10 spread there. Skylar, you think the Fed is done here? And how are they going to communicate that? Because we have a sequence of Fed speakers over the next few days. 4, last time I counted. How can they get this right?
I think, they've done actually a remarkable job in terms of we are at the end of the tightening cycle. What we've seen is that the U.S. economy is more resilient to a higher policy rate than we initially expected. At the same time, the U.S. has made remarkable progress on inflation. We've had 5 months now of negative inflation surprises. This progress on inflation, I don't think it's actually hard to get cuts given that we've had that progress. So our view is that we will get a recession and, we will get a downturn. And as unemployment rises, the Fed will cut aggressively in line with the historic experience. But the fact that we're now in restrictive territory means that we will get cuts eventually. Even if we get a soft landing and the Fed cuts their estimate of neutral, you'd expect significant cuts, but certainly on a recession. And so I think, it's actually quite remarkable that they're essentially guiding to the Fed dots for 2024 and 2025, and the market's very much buying into that.
I mean, gasoline prices are on their way up in the United States. Brent crude is flirting with $89 a barrel, and you begin to wonder whether the charts that you see from many on Twitter and from some of the houses around a second wave of inflation akin to what we saw in the 70s and 80s. Are you a believer of that kind of scenario, or do you think that the possibility of that is pretty much a tail risk that you don't really need to talk about?
I mean, there's certainly a risk that the economy reaccelerates and that puts upward pressure on inflation. Also, there's certainly a risk that supply shocks and commodity prices are rising to the detriment of inflation in the market and growth more broadly. We very much saw that strongly in action last year. But I think even, the recent more moderate rise in oil prices, that's put upward pressure on break even. So you're seeing an impact on the inflation metrics within the market in terms of the markets responding to these higher commodity prices. We've also seen a rise in commodity prices related to the war in Ukraine. And the more protracted the war is, the more the risk of stagflationary shocks. And this is a characteristic of the economy now. Geopolitical disruption and climate change, that means commodity prices are increasingly feeding into the volatility of inflation. And, there are nascent signs that the market is accepting this because you do have those kind of longer term inflation expectations ticking up, as well as the term premia.
The other thing that stood out to me, Skylar, was from JP Morgan's latest note. And to say there's complacency in sentiment evident, the VIX is near a record low. Positioning has increased. They're a little bit wary about valuations in U.S. stocks. They prefer international equities. What is the read on U.S. stocks at TS Lombard today?
Yeah, sure. I mean, I get the point in terms of sentiment as well as positioning and valuations. What I will say is that we went into this year very, very underexposed, as in the market went into this year very underexposed to equities because everyone went into this year expecting a recession. And so there was a strong rotation at the end of last year out of equities and risk assets more broadly into fixed income. And, the market is still broadly underweight U.S. equities. And so there is still room for that to provide a positive tailwind for the equity market. And, on the other side of that, yes, valuations are very high, but, there needs to be some kind of catalyst for that valuation turnover in terms of you can have valuations being sustained high for a significant amount of time. And they also don't look as unreasonable if you look at 2-year ahead earnings expectations. In terms of where we're looking from a regional exposure, yes, we've seen this quick normalization of inflation and that improves the odds of a soft landing. And essentially that means that central banks don't have to create a recession to bring prices under control. And you're seeing that the US is outperforming, and you can expect that to continue.
So a 12-month forward price earnings ratio of 19 times for the MSCI USA, that in your view is not stretched?
I mean, it's certainly stretched. And if you look at the tech sector in particular, it's more than one standard deviation rich. You know, it's definitely stretched. But the problem is you need some kind of catalyst like a recession or earnings turnover for that to turn itself over. In terms of, valuations in the long term, you'd expect an adjustment to normal, but you need some kind of short-term catalyst to get there.
For our global investing audience looking for opportunities outside the United States and outside of China, where would you point them to as we get closer to the end of the year?
Yeah, sure. So, I mean, for us, one of the other overweights we've had outside of the US was in Japanese equities. So Japanese equity performance this year, it's largely been driven by two things. It's a relatively advantageous macro cycle as well as a loose policy mix. So with the global economy softening and China underperforming, Japan's cycle dynamics look relatively positive. At the same time, the economy faces an easy fiscal stance and accommodative monetary stance. And you've also seen this very slow policy normalization process from the Bank of Japan. And that means monetary policy likely continues to be a tailwind for equities. What's more is that, the policy rate differential means that foreign investors, they're paid to hedge their FX exposure when they buy Japanese equities. There's also this kind of tailwind of a weak yen. That's been a very large positive for the country's exporters, and equity valuations, they're cheap on an absolute and a relative basis.
The swings that we've seen in yields in Japan, I mean, that hasn't been helpful at all. And we've seen some of the bond deals get canceled and the cancellations are mounting up. To what extent is that a credible warning sign for some of the stormier seas that may be imminent?
Yeah, I mean, I think a lot of this has to do with the Bank of Japan, right? So you're having this really, really slow normalization because there is very much a risk when you have yields rise in Japan, right? So, I mean, broadly speaking, Japanese investors, there's this large risk of repatriation, right? So as a Japanese investor, you're faced with three options. Either you can accept low yields locally, but the risk is capital losses on further normalization. You can buy FX hedged developed market government bonds, but the hedging cost means the yield is negative. Or you can put DM government bonds FX unhedged, but the risk is yen appreciation. And with the Fed angling for a long pause, buying US government bonds FX unhedged looks most attractive. And indeed, the flows that show post, kind of the hype around BOJ normalization at the end of 2022, those flows have been buying US Treasuries from Japanese investors. There's also kind of these existing hold to maturity positions. And so this calculus very much means that there's a risk that when you get a turn from the Fed or you get higher yields in Japan, you get this large repatriation flow that, the Bank of Japan generally would want to prevent in terms of getting large losses or other worries there.
Well, that's what we call setting a distinctive tone on a Labor Day Monday with plenty of tangible guidance for the remainder of the week in terms of actionable trading strategies and longer-term investment ideas. With Skylar Montgomery Koning of Global Data and TS Lombard. Here's what's coming up. We're going to get back to the IAA Auto Show in Munich. EVs are in focus. This is Bloomberg. Welcome to Bloomberg Markets. Let's get into another gear here with the IAA Auto Show revving up in Munich. European car makers are jostling with competitors from the US and China for an edge in EV space. Bloomberg's Oliver Crook spoke with the Mercedes CEO and asked how the company's latest model meets consumer demand.
The CLA concept is, in its technological offering, revolutionary. Three figures for you. More than 750 kilometers range, 12 kilowatt hours per 100 kilometers. I'm not aware of any car in that class that has that level of efficiency. And equally important for our customers, 400 kilometers range charged in only 15 minutes. So it really takes the game to the next level in this class.
And I want to talk a little bit about how the car looks and how that plays with the range. It's got this sort of stylized of Mercedes, a big grille, big face. How do you balance that aerodynamism with the need for range and the aesthetics that Mercedes wants to preserve?
Mercedes has always been about the perfect blend between innovation and technology on the one hand, but this timeless elegance on the other hand, you know, the aspect of the desirability of Mercedes. We have really smart engineers that get this down to the lowest drag that you can possibly think of, but at the same time, it's absolutely beautiful. And on the inside, it's roomier than you think. I'm 6'4". I can sit comfortably in the back seat of this car.
And when will you be sitting comfortably in the back of this car? When will you see this car on the road?
We're looking at market launch sometime in the first half of 2025.
And the combustion engine sort of equivalent prices at around 50,000. Will it be more or less than that?
We're not announcing prices at this stage, but all I can say is on the technological front, we're taking a significant step up in this segment. And at the same time, it will be a Mercedes through and through. So look for something exciting.
And with the CLA and BMW announcing its Neue Klasse, does this bring back the importance of the auto show, do you think, in your mind?
I think the auto show importance never went away. During COVID, we learned to deal with digital formats for everything, but it's a physical product. It's a product you need to kind of see it, touch it, feel it, and there you go.
And in terms of pricing more broadly in the business, and we're seeing a softening economic picture right now globally, how is the pricing holding up for EVs and combustion engine cars from Mercedes more broadly?
Our goal is value over volume. So we're not pushing volume. We're very, very careful about how we go to market, our go-to-market strategy. And as you can see from the results for the first 6 months of this year, that has been working quite well for us.
And can you continue to ignore Tesla's price cuts even on the higher end, which are more in competition with Mercedes products?
We're focused on value for the customer. I don't think the customer expects from a Mercedes a little bit of a roller coaster ride, but something that you can depend on. So we will continue with the value over volume strategy.
We see raw materials for EVs coming down. We see the supply chain kinks worked out. What does that look like in the future? Is that going to help you on margins, do you think, going forward? Do you think that has stabilized for the time being?
We're working on deep sourcing as far as the raw materials for electric mobility is concerned, not just to make sure that we have sourcing stability, but also make sure that we have a more economic stability in terms of raw material pricing. And I think there is an opportunity there as the EV sector scales, that we can find variable cost improvements in this area.
And there's huge concern about the state of the Chinese economy. What is Mercedes' experience of the Chinese economy right now? Is it affecting demand?
Well, all big economists at the moment are grappling with some challenges. We have higher interest rates in the United States and also in Europe to deal with inflation. In China, they have their structural problems. After 30, 40 years of an economic wonder, they're reaching also, I guess, a level of maturity where you're dealing with structural issues as well. So I think we have to take a little bit of a cautious stance on that and see how things develop and not expect rapid growth as far as the economy is concerned in the short term.
And this car show will also be marked by a lot of Chinese automakers bringing their cars to the market, introducing them maybe for the first time to many people. How do you view that in your home turf here in Germany?
The auto industry is in transformation. I think almost a disruption. It's natural that new players are going to come in, and we respect both the established competition as well as new players that are trying their luck in the business. But that's not our focus. Our focus is on the Mercedes customer, to give that customer the perfect blend between technology and desirability.
And that customer loves the G-Wagon, and I have to ask now about, is this a lowercase g? What can we expect from your announcement today?
The G-Wagon is an icon. I mean, it's almost impossible to get one, actually. It's sold out. But yes, tonight we are announcing for all the G fans out there, there will be a little G. So a son or daughter of the iconic big G. We have not announced timing yet, but if you wait for something good, it will be worth the wait.
And we are looking a lot into the future. I want to just step back into the past, if I may ask you. What was the first car you owned? What did you learn how to drive on?
My very first car was a VW Golf 1. So that's where my motoring started. But my first Mercedes, and I think that's even more important, was a C-Class in the early 90s.
I learned how to drive in a Fiat 128 in the 1980s. Let's get out to Oliver Crook. He joins us now from Munich. Ollie, I don't know what to get more excited about, an electric G-Wagon or the prospect of being able to drive an electric car for 750 kilometers, which translated, I don't use a lot of miles, that's 466 miles.
That's correct, 466 miles, and that is a range that is absolutely larger than any of the Tesla offerings, for example, which is really, one of the main competitors here for this. It's really the battle of the BEVs, the battery electric vehicles here in Munich, everybody trying to show their offerings. A lot of these European companies coming forward with these concept cars, they have EV offerings, but really they're trying to establish what the shape of their companies will look like in a fully electric future, which they haven't really done yet entirely. So you have Mercedes, BMW, Renault, Opel, all sort of doing these things, and doing it while on Friday, before the car show, Tesla fires another shot in the price war, lowering prices across the range, showing a revamped Model 3. And so really, that is sort of the background here. It's a lot of pressure along with the sort of weakening market and the sort of darkening economic outlook, particularly in China.
Ollie, I want to talk about demand globally for cars. You've been speaking to a lot of CEOs on the ground. We had a Volvo August car sales number that showed an 18% year-on-year increase in August. Are other car makers seeing similar green shoots here in terms of deep double-digit growth?
Yeah, so you've seen a lot of growth in the sort of the beginning of the year, and you see a lot of these companies have order books that are absolutely packed. It has to do with all the supply chain issues we saw, in the last couple of years, and all of those sorts of things, and finally getting those deliveries out. However, when it comes to new orders, the people that I've been speaking to here, they're really seeing a softening in the market across the board. I mean, the EVs are still growing, but they're coming from a very, very low base, so it's a bit of a mixed picture from that front.
What about the performance of some of these car makers, their stock price? I look at Mercedes, I look at the BMW group, and I ask bigger questions about a growing divergence. What are you hearing from analysts on, which company is better positioned to really level up on some of these EV theories and execution?
There's absolutely huge divergence. And in terms of the automakers here in Europe that are standing to do pretty well, it's all the luxury end, right? It's Mercedes, it's BMW, and all the sort of luxury brands. I mean, let's just look at valuations. Volkswagen, right, has a market cap that is within $10 billion of Ferrari. Volkswagen sells 8 million cars every year. Ferrari sells like 13,000, which really tells you about how investors are seeing the future of a lot of these traditional and legacy automakers. I mean, UBS put out an absolutely scathing report just Friday, right before the auto show. They're saying that the Chinese companies will double their market share globally, and that basically the legacy automakers are going to lose 20% of global market share over the next sort of 6 years. And it's all down to the cost base. The BYD models from China are 25% cheaper to produce for a lot of those companies than any of the European counterparts. However, I mean, I did ask Renault about this, the CEO, Luca De Maio. He said that the rumors of their demise have been greatly exaggerating. So some fighting back here from the legacy automakers.
I will take a Mercedes test drive or a Renault test drive any day of the week as it stands in the month of September. Ask me again in October. Ollie, great to see you. Well done. That's Bloomberg's Oliver Crook there. Let's get you a preview of what else we're going to talk about. We're going to get into the global rate environment and the upcoming central bank decisions. It's going to be with James Athey of ABRDN. This is Bloomberg. Welcome back to Bloomberg Markets. I'm Yousef in Dubai. I want to get back to some of the market indicators we're working with. It is U.S. Labor Day, a holiday as well in Canada, so some of the important cash trades are currently not open, but what we can work with is the S&P 500 mini. We're called higher by 0.5%, a firming of risk appetite after the China stimulus move. A new note out from JP Morgan. They're saying that U.S. stock valuations are looking stretched. Seek international equity exposure. Much more attractive is what they're writing. 2-year bonds currently at 3.016. Germany is selling 5.5 billion euros of 2-year government bonds on September 12th. That's right in the middle of a debate around the supply glut. Eurodollar at 108 and Brent crude just short of $89 a barrel. I want to get to the global rate story in more detail because it's turning into quite a bit of divergence. Let's start off in the U.S. You've got bets growing that the Fed pauses in September thanks to a cooling labor market. And then you've got the ECB facing higher inflation reads, and some officials say they may need to hike again. Bloomberg's Marcus Ashworth joins us now for more. So Marcus, just give us a little bit of historical context around this divergence and where it could end up in the next 3 months?
Well, I'm not sure there's going to be that much divergence. My long-standing theory is that whatever the Fed does, others will follow. We saw earlier this year certain central banks decided to try and pause, perhaps now a reflection too early, and are forced to sort of go back onto the hiking route. At the same time, clearly we've got both the Bank of England and a European Central Bank quite in flux at the moment. I think if the Fed, having done a hawkish pause and then a hike, and then if, as I expect them to pause again, and probably this will be the top of the range, I don't see how the European Central Bank, for one, cannot follow. They may dress it up with different excuses, and we've certainly seen a lot of rhetoric the last few days. We've got Nagel later on, the Bundesbank chief. He's been quite hawkish. But we saw Centeno be very dovish. Clearly, the debate's going on internally whether or not they do hike at the end of September. I think if the ECB does pause, everyone expects, a bit like the Fed this time round, that it will be the end of their hiking cycle, and they'll be very careful not to try and let that become embedded. And it's all about trying to price out future rate cuts, make sure they're not priced in, and that higher for longer, the plateau, the Table Mountain, not the Matterhorn.
Okay, I mean, with that picture in mind, Marcus, just outside of Cape Town, what is the potential pitfall of a growing consensus of optimism that is beginning to emerge, that the soft landing is, pretty much done and dusted, and that we're going to be able to avoid a recession? Where does the Fed, and maybe to a certain extent the ECB, need to be careful to prevent any complacency, or maybe even just jinx it?
This is exactly the point, and they've been very careful to sell us this higher for longer plateau, because they're really trying to make sure they don't have, as happened with the Fed earlier this year, and they very skillfully talked the market into believing that there won't be rate cuts, certainly this year, and probably not for a lot of next year. And the ECB were even more paranoid about pricing any rate cuts in, because that's what they don't want to see. So the markets, in some sense, if they get ahead of themselves and start pricing in too many rate cuts, they'll end up getting a shock, because the central banks will want to pull them straight back, yank them in. And this is what it's all about. The last thing a central banker wants now is a sickening lurch higher in second round of inflation effects later this year, early next. So all of a sudden they make themselves look stupid and having stopped hiking too early. And they seem to be telling us that's what they fear more. That second, they get the dip. We've got the dip now, but if it were to lurch higher again, they really want to avoid that. Therefore, they'd rather overdo it on hiking now. I'm not sure I believe them, but that's clearly the mantra they're trying to get across to us.
Marcus, your latest opinion piece deals with ideas on how to pass on more savings of higher rates to consumers. And it's something I struggle with here in the United Arab Emirates, which is just one microcosm of the global economy. But you've got a certain set of benchmark rates, and then by the time you look at your bank account, it's been downgraded quite a few times. And it's a real struggle for people to get their hands on these higher interest rates, especially on a wider retail basis. What are some of the ideas that you've been working with?
Well, I'm certainly seeing, obviously, the UK government has come up with a state little savings plan, which would offer rates at 6.2%. That's way better than the 5.25% current Bank of England base rate. So optically it looks great. You're going to have to pay tax on that interest income for most people anyway. So it may not be the greatest way to save, but still it's a huge leap forward compared to some of the nugatory rates we've had for the last decades or so. So, you can buy short-dated government bonds, below par, ones with very low coupons on. They can be a more tax-efficient way of doing things. It's been quite popular in the UK. And certainly we see it in Italy and in Belgium, a number of different government bonds and savings plans to try and compete, perhaps not too heavily, but certainly send notice to the banking sector that if they don't raise their savings rates for depositors to at least something within normal boundaries of where you can borrow from. Obviously, borrowing rates will always be higher. That's the net interest margin that banks' model survives on. But if it's gone too wide and the banks make too much profit, the central banks can tax, or they can regulate, or they can compete.
Marcus, we're getting to sort of mid-September now, and supposedly there should be at least a seasonal pickup in terms of the appetite of European banks to raise capital. What are you seeing in the numbers?
Well, we're seeing a definite pickup, in August. Obviously, you've got the Labor Day weekend, which means things have gone quiet again. But I expect this week, in Europe to be very busy again. We had well over $30 billion equivalent of money raised from something like 30 different issuers. We're definitely back. And more interestingly, we're back for difficult names or difficult types of borrowing. So Italian bank Monte dei Paschi, which has had a checkered past, a very long one, but a very difficult one of late. That was able to raise money below 7% for a senior bond. But more interestingly, I think, was seeing both Intesa, the very large Italian bank, and also KBC, a Belgian lender, coming with these 81, these COCOs, perpetual debt, which caught such a hard time after the Credit Suisse collapse, and clearly the cancellation of that debt. So it's great to see these types of deals coming back in the market. We expect to see a lot more.
Okay. Marcus, this has been fantastic. Appreciate the time and the insights. It's Marcus Ashworth there. I want to widen out the discussion and get out to James Athey. He's the investment director at ABRDN. James, I'm going to rip up the script and just get you to respond in terms of appetite from your side to tell clients to get into subordinate debt in mainland Europe. Where's the thinking?
Yeah, obviously there's been some tricky times in that sort of part of the cap structure in the European banking system in very, very recent times. I mean, I guess, our starting point would be that we're bottom-up investors first and foremost in the credit world. We do have significant research resources, and so we will do our homework and we will try and allocate capital where we think we're getting the most value, understanding the fundamentals at work. I think at this stage of the cycle, you do want to be prioritizing balance sheet strength and robustness. So it's not to say that we would dive headfirst into AT1s and subordinated financials, but it's not equally not valid to say that we would avoid them altogether. It is really all about value and balance sheet strength.
I mean, it's the riskiest form of subordinated debt, so possibly no surprise there. But in terms of what really matters to global markets right this minute, it is all about the stimulus from China, the pop that we saw on some of the real estate plays. Goldman Sachs has a view, and JP Morgan has a bit of a different view. In terms of the thinking at Goldman Sachs, they're saying the recent measures to help restore homebuyer sentiment moderately alleviate household interest payment pressure and paves the way for fourth quarter sales pickup beyond seasonality. What kind of impact is this going to have? I mean, maybe we're just in the first innings of repricing Chinese assets.
Yeah, I mean, I think there's two different stories. First and foremost, there's a kind of asset price outlook over a shorter time horizon, a trade, if you like, and then there are the structural issues, the big picture, the macro. I think the former, we've seen this before. China announces a series of measures, pretty piecemeal, fiddling around the edges mostly, and you can see that there will be some benefit to some portion of the population, but I don't expect lasting impact from any of the policy measures announced. None of them really get to the heart of the problems. Property has been highly speculative. There's no significant rental market in China, so really it's a savings vehicle only to the extent that property prices are rising. And now that Chinese investors, homeowners have seen the damage that can be done by their government, it's very difficult to undo that psychologically. So even if mortgages are a bit cheaper, unless there is a burgeoning and thriving rental market, it is very difficult to see Chinese investors looking at property in the same way that they have. And that leads to the macro problem, which is that property and connected sectors have been such a significant driver of GDP growth. It's very hard to see that coming back.
I mean, James, what we do know is that global emerging market investors are replacing China as a preferred destination within the EM realm because of policy issues and tensions with the West. And that change in focus because it could bolster other emerging markets. Are you looking at other emerging markets, and which ones are those?
Yeah, absolutely. Not really for China reasons. For me, it's not really about looking away from China and therefore looking elsewhere. It is really about fundamentals and valuation. And I think we've seen that policy setting in the emerging world has largely been much more credible, much more orthodox than we've seen in the developed world. We've seen significant, really, fiscal abuse, I would call it, from some of the major Western governments over the last several years in a kind of in a pro-cyclical fashion. And that really leaves some of these budgets looking very stretched at the wrong stage of the cycle. Whereas you look at some of the big emerging markets, and Mexico really stands out, but there are plenty of others. They haven't abused their fiscal position even through the global lockdown, and monetary policy setting has been orthodox as well. And that's really created great value in real rates markets, but it's also created the chance for cyclical assets like EM equities, which screen very cheap when you look compared to places like the US market, to benefit significantly in this in the next stage of the cycle, which for me is beyond the recession, which I think is coming.
James, you've been cautiously skeptical, let me put it that way, the last few times you were on the program as to whether the US is going to be successful in keeping inflation at bay and achieving a soft landing and avoiding a recession, sort of the best outcome, as it were. When you are going to hear from the Fed speakers later this week, what do you expect to hear? And how is that going to weigh on what you are going to tell clients to do?
Yeah, a very carefully chosen selection of words there, Yousef. Thank you very much. Do you know what? I think what we're seeing is increasing divergence on the FOMC. We've heard just in the last several weeks that really there is a core of doves who really believe now is the time to start thinking about the time aspect of monetary policy, not just the rate aspect. For what it's worth, I strongly agree with that idea. I think the closer you get to your best guess at tight enough, you have to start considering the future more than the past. I definitely think we're in that stage. There are some who are still very much inflation is too high, so you keep hiking. Those are, those have been the thought leaders in the early stage of the cycle. But I think that view becomes dangerous because you do risk significant over tightening. And there, of course, there are some in the middle, and I think Chair Powell is probably in the middle. So I think we'll continue to hear that there is some disagreement and divergence on the committee. They are data dependent. Going back to the conversation you had with Marcus, this is one of the problems that central banks face now. Trying to manage forward rate expectations is difficult when you're data dependent. Your forecast and my forecast will give us very different rate views if they are different economic forecasts. So we're into that phase. So I think volatility remains high. Data is key more than Fed speak. But of course, we will see the market bounce around when speakers come out as either hawkish or dovish.
Yeah, the trillion-dollar question as to whether we're in a new phase of the cycle. James, thank you for breaking that down. Societe Generale, by the way, thinking the trade isn't steepeners. James Athey there of ABRDN. Let's get you a bit of a view of what else is coming up. Nobel laureate Joseph Stiglitz is worried about China's economic slowdown. More from his interview at the Ambrosetti Forum. Next, this is Bloomberg. Welcome to Bloomberg Markets. International leaders, economists, and CEOs are gathered over the weekend at the annual Ambrosetti Forum in Cernobbio in Italy. Bloomberg's Francine Lacroix sat down with the Nobel laureate Joseph Stiglitz and asked about the current state of China's economic tensions.
China has sometimes been analogized to riding a bicycle. If you're going at 7%, everything is going well. Very hard to ride a bicycle at a very slow speed. And for 40 years, the mentality has been a high-speed system. So when you have a high-speed system, you build property well in advance of what you need. You make mistakes. 6 months later, a year later, those mistakes are corrected because there's so much demand. Now they have to do a better job of fine-tuning, and I think their system is not well adapted to doing that, particularly under President Xi, who has dismissed a large fraction of his economic experts.
But Professor, so is this first of all a political decision, right? So he wanted to consolidate power, and he could only do that possibly if the economy was strong. So does he change now that he has more control, or do you think he's weakened because of a weaker economy?
I think he's surely weakened, but that doesn't say how he will respond. You know, when you feel things are not going your way, you may respond in a more, you know, quote, stronger way that may actually be adverse to the real performance of the economy. You know, steering an economy of the size of China is not easy. China, in what we call PPP, purchasing power parity, a way of trying to equivalize different economies, is larger than the United States. No one would even conceive of trying to steer this monster, but China, President Xi thinks he can do that kind of steering. And, you know, I'm suspect.
Yeah, but by saying you're suspect, then are you expecting a lot of, you know, concern, a lot of volatility with China? And what does that mean for the rest of the world?
Well, I'm expecting, and I have been expecting exactly what we've been seeing, that they they tried this, it doesn't work, they do a little bit too much of that, and then they get worried, and then they go back to this, they shut down part of the tech sector. There's the, you know, it's not just what we're talking about here, it's not just the property sector, which is a very large part of the economy, but it's many other sectors of the economy.
But Professor, is the only way then to slow the economy, right, to be able to readjust? And what are the impacts for the US, the Fed, and Europe?
Well, I think we have to remember that in the 2008 economic downturn, China was the source of engine for the global recovery. It was pivotal. It won't be there. And in fact, I worry it will be dragging down the global economy. And that's one of the reasons that I'm so concerned about what has been going on in monetary authorities, particularly in the United States, that they've pretended that nothing's going on in the rest of the world. They've been raising interest rates well beyond anything that is reasonable, and have put at peril, particularly, I think, the European economy. I think America is going to do okay, but I worry about Europe.
And from one conversation, let's get to another one, this one with Bloomberg's Dani Berger, and she joins us now. Dani, I know you've been following closely some of the key moves in assets around the world, but I want to know what you are looking at specifically.
Well, Yousef, I take the reins from you in a few minutes' time, this Labor Day holiday market show
I don't
special.
give them away
and look,
easily.
the U.S. Yeah, I know, it's true. For those that don't know, I had to wrestle them out of Yousef's hand. Look, the U.S. might be closed today, Yousef. We might just have a traders session trade, but that doesn't mean that it's any less important what we got on Friday. Does this solidify for strategists that they can indeed start to price in a end-of-cycle type playbook? Does this mean a soft landing is in hand? Are we finally in the land of unicorns and fairy tales? An idea that was laughed upon, but maybe it's time for Jay Powell to take a victory lap. If so, Yousef, I got to imagine, and I'm going to press folks on this in the show, is the trade steepener curve the trade you want to be in? Not just because of this outlook of potential end of rate hike cycles, perhaps cuts in the future, but we're also historically going to be in the land of a deluge of issuance for this corporate bond market. Historically, on a Tuesday after Labor Day, which is tomorrow, that's when you get companies issuing this, and that will put pressure on duration. So it's kind of a double whammy of why you probably want to be in steepeners, at least for the week to come.
Well, that escalated quickly. I didn't expect that we'd talk about unicorns, but hey, it's just like tail risks in any given chart. Dani, I mean, what else are you going to be talking about with some of your guests? I mean, you talked about the Fed and the steepener trade, but you know, what else in other asset classes?
Well, we're going to have a lot of China conversations, Yousef. We're going to be speaking with Miles Yu of the Hudson Institute. I mean, it matters a lot, like you just heard from Stiglitz there, for what happens to Europe. We've seen this piecemeal approach coming out of China. It feels like every single morning we get a new announcement of something else China is doing, this time targeting mortgages and the housing market. Is it enough to shake things up? We also have the geopolitical angle of that, of Xi not going to the G20. We'll also be talking about equities with Sophie Lunn Yates. I know you had this on your show too. JP Morgan saying all the soft landing is priced in, is the only way down. And of course, Oliver Crook continues the fantastic conversations from the auto show in Munich. He'll be speaking with Michael Hsu, the BYD Europe head. I'm interested to hear what they're going to be doing to compete with the European electric car makers. Are we going to see the auto EV pricing war make its way into Europe? It's been a big thing in China with Tesla continuing to lower prices. Is VW and Mercedes, are they going to be facing that same kind of pressure to be reducing their prices for a European consumer?
I mean, one of the stories that's getting a lot of hits is this announcement that they're going to build a smaller G-Wagon, sort of a baby wagon with electric power in the United Arab Emirates that wouldn't land well at all. It's all about bigger. Yes, electric might fly, but something smaller doesn't usually work. Usually bigger is better. Maybe a G-Wagon XL would sell well in the United Arab Emirates. Would you drive a baby G-Wagon, electric G-Wagon? I'm not sure.
I mean, this is the thing about a G-Wagon, Yousef, is it's supposed to be flashy, right? Like if you're driving a G-Wagon, the point is you want people to see you. You want a black G-Wagon, can't see through the windows at all, make the rims black too. I mean, I think the point with the G-Wagon is it's kind of supposed to look ridiculous. And I mean ridiculous in a good way. The only thing I would say, Yousef, is you have plenty of open road to drive around with a big G-Wagon out there. Have you driven in London? You don't get that luxury. Maybe if you do want the flashy car, you want, I don't know, the baby version of the flashy car. Maybe that makes sense.
Yeah, I guess something to consider. I don't know. There's so many other good options out there. SQ8 and, yeah, I mean, even the electric Ford Bronco. Take your pick. Dani, this has been great. Thank you for that. That's Dani Berger there. She's going to have, of course, full coverage over the next couple of hours. Let's get back to some of the market action for you in terms of the few things that are open outside of the United States. Well, most of the world is open outside of the United States. Let's face it, with Labor Day in Canada and in the U.S. So we're not going to get a cash stocks trade or a cash treasuries trade. We're seeing risk appetite a little bit firmer. On the S&P 500 mini, we're called higher by about 0.1%. German two-year yields just north of 3%. We're seeing a move of 0.8% there. And the euro dollar at 108. The greenback is weaker on this China stimulus move. And so once again, very much the entire G10 complex getting a bit of a repricing. Look out for the Australian RBA decision. That is likely to move the needle, especially on the front end of the curve. And then Brent crude currently at $88.69 a barrel, up 0.1%. I'm looking at China more broadly, and it's something I'm thinking about. It's the chart that we showed at the beginning, and it's a chart I want to depart with as well. It's a consideration of the big moves we saw in property. It is all about these stimulus measures. And yes, you did get a pop in some of the property plays. 8.7%, the Bloomberg Real Estate Index. That is a massive move. But we've seen these massive moves in the past, and they tend to normalize and quickly retrace. And so the question will be, can these moves be sustained off the back of these policy measures and some of the down payments that have been cut for home buyers? Lenders are being encouraged to lower rates on existing mortgages. Much more ahead. It's been a real pleasure. This is Bloomberg.